On 10th March 2023, Silicon Valley Bank collapsed, making it the second largest bank default in US history after Washington Mutual and the largest since 2008 financial crisis. As of December 2022, SVB was the 16th largest bank in the United States with assets of over $209 billion. The sudden collapse of SVB has caused furor and upheaval not only in the banking sector but also in the global markets in general. The market capitalization of Silicon Valley Bank collapsed from its peak of around $44 billion to the current around $6.28 billion. Hello, my name is Soham Chaudhary, and in today's video, I'll give my take on the default of Silicon Valley Bank. Silicon Valley Bank was founded around 40 years ago in California. It ended up carving a niche for itself by funding startup companies, tech companies, private equities, venture capital funds who are willing to resort to debt to fulfill their funding requirements. SVB was also able to provide services that the behemoths of Wall Street, like JP Morgan Chase and Goldman Sachs, were unable to provide. Silicon Valley Bank was not only a bank, it was a bastion in the tech scene. Before we go forward, it's imperative for us to understand two key concepts. Number one, what is bank run? And number two, how do interest rates affect bond prices? So, let's get on with it. Banks fund themselves with mostly short term funding and hold them in long term assets. Short term funding usually comes in the form of deposits, which are liquid in nature and can be withdrawn at any point of time. Since most customers won't withdraw all of their deposits in the same point of time, banks put those deposits in long term investments and hold only a small amount to honor withdrawal requests. Managing this balance is what banks do. When large number of depositors get panicked about the state of their deposits, they try to withdraw it all at once. This phenomenon is called a bank run, and without outside help, banks usually fail to honor such requests, and as a result, it leads to bank failures. Something of the similar happened during the 2008 financial crisis, when the depositors got spooked by a falling real estate sector, as mortgages and mortgage backed securities were not giving the return that was expected of them, and thereby tried to withdraw a large number of the deposits all at once. Bonds by themselves are thought to be sound investments. They are less risky than stocks, and issuers promise to repay that amount at certain point of time in the future. A diversified portfolio of stocks and bonds help to maximize your returns while minimizing the amount of risk you undertake. Bondholders receive interest income at a fixed rate, which is not affected by the increase or decrease in the market rate. Bonds compete with each other on the basis of the interest income that they provide. When the market rate goes up, new bond comes into the market which provide a higher interest income. As a result, they become more attractive of an investment. The bad news for bondholders is that interest rate is usually fixed. As a result, when the market rate goes up, the bond issuers can't increase their rates. They are locked in. As a result, to remain competitive and viable in the market and to attract new investment, the only option is to decrease the price of the bond. As a result of this, the bondholders end up holding on to an asset that has decreased in price. For example, suppose you were to purchase a bond with the value of $1,000 that matures in 10 years. On the maturity date, you will get the original $10,000 back. The bond has a 3% interest rate, which means you will get $30 per year. Suppose now you want to sell your bond a year later, but the market rate has increased to 4%. In such a case, the buyer could buy a new bond and receive $40 yearly for around 10 years at around total of $400. Or he could buy your bond and receive $30 yearly for 9 years for a total of around 270. Therefore, to make your bond viable, you will have to sell it at a discount at around 925 instead of its original $1,000. So in short, the value of your investment goes down with the increase in interest rates. To understand the core reasons for Silicon Valley Bank's default, we have to go back to the past and look at it from a chronological perspective. SVB's problems started with the coronavirus pandemic. Being a bank that catered primarily to the tech companies, most of their clients were either startups, private equities, or venture capital funds. And therefore, SVB was very much affected by the going ons in the tech industry. During the coronavirus pandemic, there was a boom in investments in tech companies. And since the companies did not have an immediate need for such fund, they decided to park it in SVB. As a result, Silicon Valley Bank was flooded with investments and deposits from their clients. There was almost $130 billion of new deposits in 2020 and 2021. Silicon Valley Bank did not have the capacity to lend it out at the pace at which the deposits were rolling in. As a result, they decided to invest in long term US government bonds. This was not a prudent decision. Silicon Valley Bank already had enough risk built into its business model. Adding more to it was not a wise move. While the long term bonds did give a slightly higher rate than the short term ones, it locked the investments for over a decade and exposed the bank to losses if the interest rates rose sharply. The whole viability of the investments in long term bonds rested on SVB's assumption that interest rates won't go up sharply. Yet, that is exactly what happened. As inflation started to rise in the last few months, to dampen its impact, Federal Reserve had to sharply increase interest rates. As a result, deposits became more expensive. Last year, Silicon Valley Bank's portfolio lost around $15 billion. However, this was only the start of their problems. The tech companies, which had formed the base of SVB's clientele, were hit by a cash crunch due to their valuation falling from the pandemic era high. So they started to withdraw their deposits from SVB, either to spend it or to invest it in other ventures. To honor such withdrawal requests, the Silicon Valley Bank's management decided to sell some of the bonds that it held in its portfolio. However, the value of those bonds had already fallen due to Fed's rate hike. Around $21 billion of bonds were sold at $1.8 billion loss. SVB decided to make up for this loss by issuing fresh equity. Silicon Valley Bank had decided to sell about $1.25 billion of stock and $500 million of mandatory convertible preference shares. And they had even gotten a commitment from General Atlantic, which was contingent on the share sale being successful. Goldman Sachs, the bankers in this case, were able to drum up enough demand for the share. However, a sudden drop in its valuation, where around $9 billion of market capitalization were wiped out, made the share sale almost impossible and the bank's collapse imminent. Both the bond sale and the issue of shares were meant to reassure the investors. However, it had the opposite impact. The investors got spooked. A recent report found that only 3% of the deposits held by SVB were under $250,000. This is important because according to FDIC, deposit insurance is still $250,000. As a result, most of these investors, most of these clients started to pull more money from the bank. As fear gripped the markets and few of SVB's large clients started to pull their money, a bank run had become certainty. On Thursday, 8th March, SVB faced around $42 billion of deposit withdrawals. A question that is being asked quite often is, does SVB's collapse signal a banking crisis like the 2008 financial crisis? Well, the short answer is no. There are a few reasons for that. Firstly, SVB had an unusually high percentage of its deposits in fixed rate securities, around 56% of the bank's total assets. For other banks, it is usually around mid 20s. While that is a high number and will impact the bank's profitability, but it won't impact the bank's stability. Secondly, SVB had an unique client base. That is, most of its clients were startups, tech companies, venture capitalists, and private equities. As a result, SVB was impacted pretty severely by the happenings inside the particular industry. However, other banks usually have a pretty diverse client base, and so they won't be affected by the situation in a particular industry. Thirdly, overwhelming amount of SVB's clients were businesses. That is not so common with other banks. And lastly, we can say that overwhelming amount of SVB's deposits were over 250,000. That is around 96% of it. That is important because most of it, as a result, was uninsured. This is a pretty high number even in the banking industry. Now that we have an idea about the reasons behind SVB's collapse, I think it's time for us to take a look at the steps SVB could and should have taken to prevent the situation that we presently see ourselves in. To cater to a particular niche market is a pretty risky affair. On the plus side, you will be greatly impacted by the positives in the market. However, on the flip side of it, you will also be severely impacted when the market goes down. To have a stable bank, it's very important to have a large over dependence on a certain asset class is never a good idea. Banks usually invest their deposits between various asset classes in different regions across the world. SVB CEO Mr. Baker had petitioned before the Senate Banking Committee that the threshold to be characterized as a systematically important financial institution and thereby be liable to increased scrutiny be increased. As such, the threshold was increased from a previous $50 billion to the current $250 billion. Such an increased scrutiny might have pointed out the shortcomings of SVB's operations and potentially prevented a collapse. As such, government should do proper scrutiny regarding the stability of the banks, even including small and regional banks. Stability and proper functioning of banks depend on most cases on the trust the depositors and the public has on it. As such, increased transparency and better communication should be a key focus of every management. Point number 4. The stability of banks in most cases depend on the trust that the depositors and the public has on it. As such, better transparency and improved communications should be a key focus of every management. In conclusion, we can harken back to the old adage: too much risk, and too little diversification as the primary cause for Silicon Valley Bank's collapse. Thank you.